Most people enter the stock market excited. They buy stocks because prices are rising or because someone told them that this stock is very hot. Months later, they are scared, disappointed, or even confused. Not because stocks are bad, but because they skip the basics. Today, I'm going to teach you what you must know before buying any stock on the Ghana Stock Exchange or any stock exchange that you know, whether it's a bank, an insurance company, a manufacturing firm, or a telecom company. This knowledge will save you from stress. The first and foremost, know why you are buying that stock. Every stock must have a purpose in your portfolio. Are you buying it for income? That's dividends. Are you buying it for growth? Or you are buying it for trading? Let me take them one after the other. When you talk about trading, you are looking at short-term price rises. You talk about growth. You believe that maybe this company is going to perform in the next 5 to 10 years. So you buy their stocks and you hold for the upcoming years so that there will be price increments so you can sell and earn more. When you talk about buying it purposely for income, that's when you think about the dividend. Are you buying it for dividend? Some companies give dividend after 6 months, others to yearly, others doesn't give at all. So the second thing is you must know what you are really buying. When you buy a stock, you are not just buying numbers on the screen. You are buying parts of real business. Just imagine if your friend owns a bakery and you give him money and in return he gives you 10% of the bakery. If the bakery does well, you earn more. If it doesn't do well or it struggles, your money or your return also decreases. Same way applies to stocks. Buying GCB, MTN, Cowbank, or any other stock on the Ghana Stock Exchange tells you that you are owning parts of that company in real business. If you wouldn't own the business privately, don't buy their shares publicly. How does the company make money? You have to ask yourself this simple question. How does the company earns revenue? For example, banks earn from loans and fees. When they give out loans, that's when they earn. Insurance company also earn from premiums. Manufacturing firms also earn from sales. Agriculture company earns from harvest output. The more predictable the income, the more stable the asset or the stock. Price does not mean cheap or expensive. Many beginners think cheap stocks are better. That is one of the biggest mistakes they make when they enter into the stock market. What matters most is value and not price. To add up, look at the company's past history or look at the company's history. Before buying any other stock, look backwards. Ask yourself, has the company been able to survive difficult times? Has it paid dividends consistently? Has it remained profitable? Example, a company that has survived economic downturns shows signs of resilience. Past performances does not guarantee the future, but it reveals management discipline. Another point is you have to understand risk and volatility. Stocks moves ups and down. This is normal. Daily example, even a good shop has slow months, and that's very true. If price drops will make you panic, you invested too much. Very important line. Never invest money you need urgently. Another thing you must know is liquidity. Can you sell when you want to? Liquidity means how fast you can sell or buy shares from the Ghana Stock Exchange or any other stock exchange that you are using. Some stocks trade daily, others may wait for days or months. For some stocks on the Ghana Stock Exchange, even when you place a trade, it won't be able to execute. Sometimes it expires or you have to cancel and then place another one. A good company can still be bad if you can't exit when needed or when you want to sell your shares so that you use the money for something. Diversification is your safety net, just like I keep on telling you that never put all your eggs into one basket. Never put all your money into one stock or in one sector. You can hold banks, consumer goods, telecom companies, agriculture, and insurance companies. You must balance your portfolio. Emotions, the silent portfolio killer. Fear and greed destroy returns. Fear causes panic selling, and greed causes overbuying at peaks. The market rewards patience, not excitement. A lot of people fear when they see the prices dipping, which pushes them to sell. Before buying any stock, pause and ask this simple question. Do I understand the business? Do I know what I'm really buying? Can I hold it through ups and downs? Investing is not about being fast, it's about being right and being patient. This is Legend TV, where we build wealth with knowledge and not hype.